see you. One of our guests said yesterday, forget bulls and bears, we're in a kangaroo market. It's hard to attach any reason for stock movement some days. But why do you think stocks are up? Just because people are looking for bargains?
Yeah, I kind of like that phraseology, a kangaroo market. It does feel like what we're in. I mean, kangaroo courts, kangaroo markets. Sometimes these things don't make a heck of a lot of sense. I do think that's the environment that we're in right now. Look, there's a lot of trading volume going through, but I'll tell you, it's thin. Markets are not deep right now, and so it doesn't take a whole lot to push prices around either to the upside or to the downside right here. And I'm not talking about just stocks, bonds, FX, everything's a little bit thin right now. Oh. And so I think the signal to noise ratio that we're getting out of market prices is probably a little bit degraded right now. Although it is helpful to have a nice day.
That's interesting. That so some market players are just saying, I'm just going to stay out of this, and trading liquidity is not that big.
Well, it's sort of mechanical, Andrew. So, anytime you have high volatility, everybody's risk models are volatility based. I mean, you hear about VAR models or value at risk models. They all have to do with volatility, and the upshot is when volatility goes up, you're able to take less risk. And so, this is generally why we have downward pressure in markets when there is, high volatilities, because it's just sort of a mechanical thing. Folks have to de-risk, and basically get smaller, and the world runs net long. So that just means generally selling of assets. So, there's a little bit of that going on, this week as well.
What's your view on this sell-off in U.S. bonds? Maybe we could have a look at the 10-year yield over the past 5 years. The 10-year benchmark earlier today topping 4.5%.
Yeah, I think it's probably a little bit less about the levels and more about why we're getting to the places we're getting. And so, the thing that's got ours and quite frankly, a lot of folks' attention right now is the performance of both the dollar and U.S. treasuries in a risk-off environment. Typically, or at least over the last, call it 25 years, whenever there's been a big risk off, people generally flock to the U.S. They flock to U.S. treasuries as a safe haven. And right now, U.S. assets are higher yielding, and they're certainly not acting like a safe haven asset. If this is a truly a regime shift where people don't want U.S. dollar denominated assets in times of heightened risk, if they're not viewed as sort of kind of the flight to safety phenomenon, that has really deep implications for not only portfolio construction but for the performance of U.S. assets relative to other non-U.S. assets around the world.
I mean, if there is a significantly reduced asset for American treasuries, that's going to increase borrowing costs for the U.S. government.
It will, and so this is part of the shooting yourself in the foot strategy that seems like it's being implemented right now here, and it's not super helpful. I don't know what what blowing up the global trade regime is meant to accomplish in terms of having the rest of the world less dependent on the U.S. That is generally conferred to the United States quite a lot of privilege in terms of having the U.S. dollar be the reserve currency. It's if we're moving away from that, it's not it probably doesn't bode super well for U.S. assets, again, just relative to the rest of the world.
You say it's important to recognize that this is a man-made problem, this trade turmoil, and it could be unmade. And of course, we saw that big relief after Trump delayed some tariffs for 90 days.
Yeah, and this is something that we have to harp on. And also the thing that makes trading through this or kind of managing money through a period like this particularly challenging. Because the fundamentals do matter and some of the macro moves do matter, but they can be literally undone or kind of redone at the press of a button. This is not sort of an environment that we have been in this before, not quite to this extent though. And so this is we have to keep in the back of our heads that we probably will get rips like we got on Wednesday. Again, kind of through this, and just you've got to subscribe to Twitter, or you got to subscribe to Truth if you're going to be sort of actively managing money through a period like this, and it's just it sort of comes with the story.
Are you seeing bargains in U.S. equities now with the drop in the markets?
Yeah, we're definitely starting to detect some. I mean, they're still sort of more domestically inward-facing companies that are getting thrown out with the proverbial bathwater, and so those are becoming particularly attractive here. But anything that relies on global sales is something that you have to call into question what their earnings stream is going to look like going out into the future. So that's what the market is trying to figure out right now. It's tough to figure out the 1,000 different stocks in real time, what their earnings picture looks like. like, given a drastically different set of trading parameters that were being thrust into. And so, that's certainly part of the volatility. But anything that's more inwardly focused is certainly much more of a bargain today than it was a week ago.
What about, are you looking for defensive names in the U.S., consumer staples retailers, for example?
Yeah, you have to start looking at those things. Look, consumer staples were generally names that we really didn't like at all because as of a month or two ago, we thought the probability of a recession was vanishingly small. But that probability of recession has probably been about a coin flip in the United States. And anytime you get an environment like that where you have kind of slow growth, the staples names are going to be a haven for safety inside of the equity market. And so, they're certainly more attractive and gaining more attractiveness by the day.
The stock market is not the economy, obviously. If the U.S. does go into a recession, is that a great reason to lighten up on stocks decisively, or could stocks ride it out? I mean, interest rates would come down, presumably.
Presumably they would, and that would be our expectation. Although, like with how everything is moving, over the last week, it's not. I don't think that's clearly a certainty. Mm-hmm. But if rates do come down, if the Fed does go into sort of aggressive cutting campaign in terms of trying to buffer U.S. Economic growth, that should put a floor under the market. We should remember, like, the backdrop to this market, not only in the U.S. but globally, it's actually pretty good. And, the starting place matters. And the starting place for this, the current turmoil was, a global economy that was pretty good, like not screaming, but pretty darn good. A consumer base that's incredibly resilient, really strong, and with employment at basically all-time highs. Inflation coming down fairly predictably and fairly steadily. So that's your backdrop. You combine that with incredibly low leverage at the household sector level, and we don't really have a recipe for a complete disaster in terms of markets. You don't have the sort of the leverage effect that can really kind of spiral things into poorly into ever and ever worse conditions. But at the same time, we are getting a growth downgrade because we're just we're subjecting ourselves to the second largest, or maybe the largest, depending how you calculate it, tax increase in United States history, and that's going to slow growth. And anytime you slow growth, you increase the probability of recession. And in a recession, we know two things happen. You get earnings taken down, and you get multiples taken down. So you get hit from both sides if you're a stock market investor. And so that's what the market, again, is trying to struggle with right now, figure out what are these new probabilities, what does the world look like in a month from now. It looks a lot worse today than it did a month ago.
Thanks very much, Scott. Really appreciate it.